And we are live. Good morning. For most people across the country, it is absolutely bitter cold. It is cold here. Last night I went to go pick up my daughter and it was -9 degrees. It has been absolutely cold. And during these types of times, I remember I used to live in the mountains over by Breckenridge, that area where Copper Mountain is, and Breckenridge and Frisco in Colorado. And if you know that area, it gets really cold for a long period of time. And I remember having yeah, a situation where your energy would just continually drop and drop and drop, and I never really figured it out when we lived there. But I've actually had people ask me how I can keep things going sometimes, and I thought, it's really interesting. What can I do to get my energy up, and maybe other people keep their energy up? So I just did some poking around, and I found this Harvard medical study. uh, Harvard Medical School had 9 tips to boost your energy. And I was looking at the list and I'm like, yeah, some of that I can see, but then I have my own list. But my own list is only like 4 things. So I thought I'd share that with you. And then I'm going to talk a little bit about the markets and the economy, actually, not the markets, but the economy. But all right, so here's my list of how to maintain energy. Like whenever I feel my energy slipping off, I started feeling it slipping off a couple weeks ago, and then I kind of changed my routine, and my energy level has come back up. So this kind of works for me. The first thing for me is to absolutely get on a routine where I'm going to bed at the same time and I'm getting up at the same time, hopefully, try to get it as close as I can. And to get on an exercise routine where every day, almost every day, I'm doing some form of exercise. It's not about the amount of exercise, just the consistency of it. And then the other thing that I find is that if I write things down in my head, then I can sleep better. So a lot of it is just writing things down and getting it out of your head. And then for me, also deep breathing and meditating sometimes, like when I'm exercising, just before or after, really kind of helps me just relax myself and get in a routine. And then staying away from anybody who seems to be negative to me for some reason. If you just stay away from negativity, that also boosts your energy. So those are my 4 things. Less sugar and less carbohydrates would be the next one. Eating more protein, less complex carbohydrates, less sugar, and just eating a little bit less. That helps me a lot. Those 4 things: less carbohydrates, routines, sleep, exercise, meditation, writing things down, and staying away from toxic people. Now, if you ask the Harvard School, what they say is to control stress is you got to lighten your load and you need to exercise, which I agree with. Avoid smoking. I don't smoke, so that's not an issue. And then restrict your sleep. They have a very interesting thing they talk about with restricting sleep, where they're basically saying if you deprive yourself of some sleep first and then you add sleep later in increments, that you could actually find out how much you should be sleeping. You may actually be sleeping too much. And then eat for energy, which is similar to what I said. They eat with low glycemic index, less sugars, and using caffeine to your advantage. Well, this is Market Coffee Talk, so here's my fresh brew of coffee. So I go live in the mornings and just try to have an uplifting message, and then talk a little bit about the markets, because we're investors. And if you have any questions or anything, feel free to post, because ask them on this particular comment area, and we can have discussions. So that's just go for it anytime. Let's see, limiting alcohol and drinking water. Drinking water is always one that it's super dry here in Colorado right now. So my mother-in-law actually just sent a picture of her backyard in San Antonio, Texas, and I was surprised. It was extremely, extremely unusual to have that much snow. She said it was like 5 or 6 inches. There was quite a bit of snow in her backyard. So now, okay, so I want to dive into a topic that a lot of people have been avoiding talking about, but is very, very clear what's going on. And that topic is actually inflation. So if you look at what's going on right now in our economy, the economy is picking up now, right? So we're starting to open up. The vaccine is rolling out. It's gaining some speed. And we are starting to see that affect prices, right? We have commodity prices are starting to head higher now. Government spending has been, really off the charts. And we're also seeing higher fiscal aid packages that are coming through. At the same time, the Federal Reserve is, pledging that they're going to have easy money for a long time. So they're basically putting more money into the system. And we have the demographics are changing. If you look at one of the things we like to look at is what is the age of young people compared to the middle-aged workers. So if you have more younger people entering the workforce compared to middle-aged people who are not, who are kind of more towards the end of their work cycle, you tend to have more inflation or more consumption, which could lead to more inflation. They start buying houses, which we're starting to see. The millennials starting to buy houses, getting careers, having families, and they're buying furniture, housewares. Companies like Lowe's, all of that. All those demographics are really pro-consumption, pro-inflation. And another really big one that is never really talked about, and I wish the politicians would actually like fess up what's really happening with the labor. We talk about, wages are not keeping up. Wage pressures are actually starting to increase now because it's really has been more to do with the global labor supply. When we entered in the trade deals, we basically we allowed this huge labor pool to enter the global workforce, which put downward pressure on our wages for a long, long time. So, they blame, people have blamed capitalism and other things, but the reality of it is the supply and demand of labor that has been the primary issue there. And there's been some effects because unionization, unions have been less, and technology has been increasing, which is allowing us to be more productive. You put all those things together, that kept wages low and inflation low, but we're starting to see a deglobalization right now, where we may be bringing more manufacturing in-house, and we're starting to see that in the wages. And this has to do with the US dollar and the deficits. The downtrend in the US dollar could support a rising inflation rate. So this is something that no one is, you don't hear people talking about it enough, but this is really a primary big trend. So let me show you a few charts here. This chart is the 5-year forward inflation expected rate. So we can, with some financial math, look at what the market is anticipating the inflation rate to be. And if you look at this, we're going back quite a ways here. From 2012 to 2020, you can see this long downtrend. And recently we saw a pretty dramatic spike, and now we're starting to see it pick back up. It's just at the beginning phases. But if you look at a more an earlier indicator of what can bring on inflation, that would be the average hourly earnings. So we're looking at how much money people are earning per hour. And this is basically a year-over-year change. So it's an annual rate of change. And if you go back to 2008, we had this big drop, and it's kind of like this bull pattern, and it's just been steadily moving up and up and up and up. And then we saw a big, there's some noise in this data because of this financial crisis, not financial crisis, but the pandemic, having to do with hours being dropped, right? Hours dropped, but the overall amount of earnings stayed relatively the same. So that big spike is really a little bit of you need to kind of factor that out. But if you look at what's happening overall, that trend is accelerating higher. So, and that is, by the way, that is one of the largest input costs for companies is salaries. So, and when salaries go up and up, margins get compressed, profit margins get compressed. What happens is prices have to go up. Now, this is really important because this all feeds into the federal government. One of the things a lot of people have not really thought about is that the US government has a tremendous amount of obligations that are tied to inflation. We have Social Security, healthcare costs. If inflation goes up, the amount of money they need to spend goes up a lot. And if we don't have the money coming in, that's more deficit spending, which means more debt outstanding, which lowers the value of the dollar, which increases inflation. It's a big cycle, right, that's happening. This chart here shows the U.S. public marketable debt outstanding in what's called Treasury Inflation Protected Securities, or TIPS. And these are just bonds that pay investors more money if inflation goes up. And I would imagine that the U.S. government does not want to issue a ton of these anymore right now. But you could see that these obligations have been going way up. We're at like $1.55 trillion of these. And this is just one example of the type of obligation our U.S. government has that is causing a debt problem, right? And that's more deficit spending. It's kind of an ongoing cycle that we're dealing with. And so what should investors consider now? I wanted to give you a few tips on how this is going to affect bonds, because a lot of people, we have the stock, that's a whole nother, element, but I want to talk a little bit just about the bond portion, the more secure part of the portfolio, fixed income. So if we expect at least a moderate increase of inflation, if we have that, what should you do? You should keep your duration low. So you shouldn't go real long term on your investments in bonds. You should keep them relatively short. And you do that so that you can actually have money coming due that can be reinvested at higher rates as rates go higher. Consider Treasury inflation protected securities. Sorry, I was going to sneeze. So consider TIPS. They could potentially pay you more interest over time, and add yield sparingly with select medium-term corporate bonds as rates rise. So if we're right and rates do start inching their way up, just add sparingly to corporate bonds, which could give you a little more yield than those treasuries. Treasuries are relatively more secure, and the corporate bonds will pay you more, but they tend to have more volatility. A couple strategies to think about, simple strategies, would be a bond ladder. A bond ladder would be just spacing your maturities out, kind of in a straight line fashion by year, like 1 year, 2 year, 3 year, 4 year, 5 year. Split your money up that you have in bonds in over those maturities. Another would be a barbell, which I think this is a better strategy, is where you put some on the long end and some on the short end, and your average duration is kind of in the middle, but you have a little bit more flexibility in terms of what happens when the rates change. So if we're wrong, rates go down, your long-term bonds are going to do very, very well. If rates go up, you still have short-term rates here that are maturing that you could add into the higher rate. So those are the kinds of things I think that investors could think about and work on, rather than just going out and buying the bond indexes. That's one thing not to do, is to go and buy the bond indexes, because those bond indexes, they're market cap weighted. So they're based on how much issuance is out there. And a lot of people are going to I want to use, I guess I can say it, they go out to Vanguard and they buy a bunch of Vanguard bond funds. Those bond funds, they base how much they buy of bonds based on what's being issued. Well, who issues more debt? Companies that are not doing as well. Like, do you really want to put more money in companies that are not doing well? Or should you be targeted in what you do? So inflation is something that's very a potential reality. We see the facts are actually support this in many different ways. We just outlined them before. And so I think investors should really think about that. Now, stocks can be affected by this too. So some stocks should do better than others, depending on what kind of interest rate environment that we get with it. But we have to be careful that as interest rates rise, that becomes competition for stocks, right? Because we can say, well, if rates are higher, maybe I won't have so much stock. I'd rather have something more secure with some bonds. So we have to be, as long as we don't have a big acceleration in interest rates, these equities should do pretty well. Stocks should continue to do pretty well relative to bonds, because we have a long way off before these interest rates are going to be attractive, because they're so low right now. So if you have any, what are you doing to increase your energy right now? Are you doing anything at all? For me, I've outlined those things for you, and I think that those are probably the best thing for most people. All right, so we've talked a little bit about the markets. We've had a little bit of coffee, talked a little bit about the energy. Hope you stay warm, and I'm going to sign out for now. Hope you have a great day. Bye.